Here is a question worth asking on Monday, the 3rd of August, 2026. How does a currency rally lose its nerve inside a single trading session? That is exactly what the euro has done today. The single currency opened firmer against the dollar, then paired those gains as the European session wore on, with FX Street reporting the move around lunchtime UK time. The reason is not one story but two running side by side. First, the stop-start negotiations between Washington and Tehran. Second, a Federal Reserve that still has not handed markets the clear policy signal they are asking for. When two macro unknowns land at once, the honest response from a trading desk is to do very little, and that is what we are seeing. Rewind a week and the picture makes more sense. On July 27, 2026, reports described a pause in U.S. strikes on Iran as President Trump weighed diplomatic options. 3 days later, on July 30, 2026, the tone hardened again, with Trump stating that the United States would strike Iran hard. That whiplash between de-escalation and threat is precisely what makes positioning so difficult. On the same day, Societe Generale published a note arguing that the dollar is essentially waiting for clearer policy signals from the Fed rather than trending on its own. And this is not new territory for the euro. Back on June 23, 2026, it slipped below 1.1450 during an earlier wave of peace deal uncertainty, while traders sat on their hands ahead of Eurozone and US PMI data. You can see the identical hesitation in other assets today. Silver has struggled to hold its opening gains, with XAG/USD capped by hawkish Fed expectations, because a higher for longer rate path raises the opportunity cost of holding metal that pays no yield. The Canadian dollar edged lower on July 30, 2026 as the greenback rebounded and traders waited on key US macro releases. That is one trade wearing three different costumes. For people outside the market, the effect is practical rather than dramatic. UK and Eurozone travelers see their rates drift rather than move decisively. Importers pricing dollar contracts face a wider band of uncertainty on hedging. Businesses invoicing in dollars are finding it harder to lock in a rate with any confidence this week. So where does this go next? In the near term, the euro is likely to stay headline-driven rather than data-driven, because a single line from Washington or Tehran can outweigh a mid-tier economic release. Watch for two specific triggers. 1. Any confirmed progress or breakdown in the US-Iran track, since a credible de-escalation would lift risk appetite and typically pressure the safe haven dollar. 2. Upcoming Fed commentary and US macro data, which will either validate or unwind the hawkish pricing currently supporting the greenback. Until one of those resolves, expect range-bound trading with sharp intraday spikes rather than a clean trend. Thin August liquidity can exaggerate those moves, so the size of a jump may overstate its actual significance. The takeaway from Monday, the 3rd of August, 2026 is simple. The euro is not weak and the dollar is not strong. Both are hostage to two unresolved questions, and the market is refusing to commit capital until at least one of them is answered. If you trade, that argues for smaller size and wider stops rather than conviction positions. If you are hedging business exposure, staggering your cover looks more sensible than trying to time a single perfect rate. And if you are simply watching, remember this: paired gains are not a failed rally, they are a market telling you it lacks information. Clarity, when it arrives from the Fed or from Iran, is what will finally set the direction.